International stocks are back. And if your first reaction is, yeah, sure, I remember 2012, I get it. But here's a stat that should make you sit up a little straighter. The top 10 stocks in the S&P 500 now make up roughly 40% of the whole index. That is not 500 stocks. That is a group project where 10 people do all the work. Compare that to a broad international fund where the top 10 holdings are about 11%. Same structure, totally different concentration risk. So, are international stocks hot again? And if yes, where and how do you invest without turning your portfolio into a geography quiz? Here's what we're covering. 1. Why international is suddenly getting the spotlight again. 2. The 3 places that matter most right now. 3. The simple, boring way to invest internationally that actually works. Plus the one tax detail most people miss, and it is a silent performance killer. Let's go. Quick definitions, because the finance industry loves making simple things confusing. US stocks are what they sound like. International stocks means everything outside the US. Inside that, 2 buckets. Developed markets, Europe, Japan, the UK, Canada, Australia. Emerging markets, India, Brazil, Taiwan, and yes, China is usually in here too. Now here's what trips people up. If you buy a total world fund, the US is still the main character. The world index right now is roughly 63% US. So if your entire portfolio is the S&P 500, you are not normal. You are aggressively home-biased. Not morally, mathematically. And that's fine, until it isn't. So why is everyone suddenly talking about international again? 3 tailwinds: valuation, catalysts, and the dollar. Tailwind number 1, valuations. For most of the 2010s, the US market didn't just outperform, it got more expensive while outperforming. Which is awesome when you already own it, and awkward when you are buying more of it. Meanwhile, international markets spent a decade being that band your friends swear is amazing, but you never actually listen to. Now, the gap is wide. Non-US stocks have been meaningfully cheaper than US stocks on forward price to earnings. Not a little cheaper, more like Black Friday sale and the US aisle is still full price. That valuation gap matters because it changes the math of future returns. If 2 businesses grow similarly, but one starts cheaper, the cheaper one has more room for the multiple to expand. And if the expensive one has even a tiny earnings miss, it has more room to get punched in the face. International is not hot because it is trendy. It is hot because the starting price is better. Tailwind number 2, real catalysts. International is not one story. It's a bunch of stories happening at the same time. Europe is running a defence and infrastructure spending cycle. Japan is going through corporate governance reform that's actually forcing companies to care about shareholders. Emerging markets are absorbing supply chains that used to run through a single country. The pitch is not America bad. The pitch is the rest of the world is doing things again. And markets tend to like when countries do things. We'll go deeper on each of these in a minute. Tailwind number 3 is the sneakiest one. The US dollar. When you buy a Japanese stock as a US investor, you don't just own the company. You own the company plus the yen. European stock? Company plus the euro. In a strong dollar decade, that currency layer can feel like running up a down escalator. Your stock goes up in local terms, the dollar flexes, and your return gets sanded down. But in a weaker dollar period, the escalator flips. You get a tailwind. This is why international comes back in waves. Currency moves can make the same underlying companies look like heroes or villains in your brokerage account. So, valuations are attractive, catalysts are real, and currency may be shifting from headwind to tailwind. Which brings us to the fun part. Where do you actually invest? 3 stops, Europe, Japan, and emerging markets. Stop 1. Europe. For years, the Europe joke was simple. Low growth, old demographics, lots of regulation, and every rally got smacked by some new crisis. But the story has shifted. European indexes are not dominated by mega-cap software the way the US is. They lean heavier on financials, industrials, and global exporters. That matters because different sectors lead in different market regimes. And right now, Europe has a very specific catalyst. A multi-year defence and infrastructure spending cycle, led by Germany. That kind of fiscal push does not just help one company. It lifts entire supply chains. Engineering, equipment, construction materials, logistics, and defence contractors. Do you need to stockpick German industrials? No. A total international fund already owns Europe. If you want extra exposure, a Europe-focused ETF works, but it is not required. The takeaway is simple. Europe is not a tech replacement. It is a different sector mix. It is diversification you can actually feel. Especially if the US megacap trade ever cools off. And yes, it can be boring. Boring is a feature. Stop 2. Japan. Japan has been the value trap punchline for so long that a lot of investors stop checking. Which is exactly why it is interesting when it starts working. The biggest shift has been corporate behaviour. For decades, Japanese companies were famous for hoarding cash, cross-shareholding, and not really caring about shareholder returns. That culture is changing. The Tokyo Stock Exchange has been pressuring companies to focus on capital efficiency, return on equity, buybacks, and better use of balance sheets. That's not hype. That's a structural nudge. When you combine governance reform with global investors paying attention again, you get a market that can re-rate. Japan also sits in a sweet spot for a big global theme, the hardware and supply chain side of technology. Not apps and software, the physical stuff. Equipment, components, materials. So Japan gives you two things at once. A governance-driven turnaround story and exposure to the industrial backbone of tech. Now, Japan is currency sensitive. If the yen swings hard, your dollar-denominated returns swing too. That is not a reason to avoid it. It is a reason to size it like an adult. You already get meaningful Japan exposure through any broad international fund. A dedicated Japan ETF is a tilt, not a necessity. Stop 3. Emerging markets. This is where the conversation gets spicy, because emerging markets are not one thing. They are a bundle of countries with different politics, different currencies, and wildly different risk profiles. Why do people invest here? Growth. But the trade-off is volatility. If developed markets are a smooth highway, emerging markets are a mountain road with potholes and incredible scenery. Two reasons they are getting attention right now. 1. Valuations in parts of emerging markets are cheaper than the US. 2. Supply chain diversification. Global manufacturing is spreading out, and the countries that can absorb that demand are winning. India is the obvious headline. So are parts of Southeast Asia. So is Mexico, depending on the industry. But emerging markets also include China, and that is its own separate conversation. Here is the practical version. If you want emerging markets, a broad EM fund is the simplest path. If you want EM without China, there are ETFs for that too. That single decision changes your risk profile more than most people realise. Emerging markets are not a core holding for everyone. They can be a satellite, a smaller slice. But they are one of the most direct ways to add a different economic engine to a US-heavy portfolio. Alright, now the part people actually came for, how to invest. Because international stocks are back is not a strategy, it is a tweet. 3 ways to do this from easiest to nerdiest. Option A, one fund, a total world stock fund. One ticker, one allocation, global exposure. The US is still the biggest piece inside it, but you automatically own developed and emerging markets too. This is the I want global diversification, but I also want to live my life option. If you are a set it and forget it investor, this is ridiculously underrated. Option B. 2-fund setup. 1 US total market fund, 1 total international fund. That's it. You get global stock coverage, you control your US versus international split, and you can rebalance once or twice a year like a responsible adult. This is also the easiest way to fix the most common mistake I see. People own 100% US, then add a tiny 5% international sleeve and call it diversified. 5% international is like putting 1 broccoli floret next to a mountain of fries. Technically, yes, it is there, but it is not changing the meal. So what is a reasonable allocation? 3 common defaults. World weight. Around 60% US, 40% international. Classic middle ground. 70% US, 30% international. Minimum effective dose. 80% US, 20% international. Pick one, stick with it. Rebalance. Most of the benefit comes from being consistent, not from picking the perfect number. Option C, core and satellites. This is for people who want a little extra spice, but not a full-time job. Core, a total international fund. Satellite, small tilts. Examples, a developed markets overweight. A small cap value tilt internationally. A small emerging markets sleeve. A region tilt, like Japan or Europe, if you have conviction. But here is the rule. Satellites should be small enough that if they underperform for 3 years, you do not rage sell them at the bottom. If you can't hold it through boredom and pain, it is not a satellite. It is a grenade. Now, 3 mistakes that make international investing feel cursed. Mistake 1. Performance chasing. International tends to lead in bursts. People notice after the burst, buy in late, then it goes quiet and they quit. Classic cycle. If you want international to work for you, you need the habit before the headlines. Mistake 2. Overlapping funds. People buy a developed markets ETF, then an international ETF, then a world ETF, then an emerging markets ETF, and now they own 4 funds that all hold the same big companies. You think you diversified, you actually duplicated. Mistake 3 is the quiet one. Taxes. When you hold international stocks, foreign governments may withhold taxes on your dividends before they even hit your account. In a taxable brokerage account, you can often claim a foreign tax credit on your US return. If your foreign taxes are small enough, there is a simplified method that avoids extra paperwork. Here is why this matters. If you hold international in a retirement account, like a 401k or IRA, you generally cannot use that credit. So a lot of people prefer holding international index funds in taxable accounts when possible, because the foreign tax credit can offset that drag. This is not make or break for everyone, but it is one of those small edges that compounds over a decade. And yes, it is annoying. Welcome to investing. Quick word on currency hedging, because this is where the internet gets weird. Unhedged international funds mean your return includes currency moves. Hedged funds try to cancel them out. Hedging can reduce volatility, but it also removes the chance of a currency tailwind. What do most long-term investors do? They stay unhedged. Over decades, currency tends to wash out. If you are making a short-term tactical bet, or you are very sensitive to volatility, hedged funds can be a tool. But tools can be misused. A hammer is great until you try to fix a computer with it. All right, here is your 60-second plan. If you have zero international right now, the easiest upgrade is Step 1. Pick either a total world fund or a US fund plus a total international fund. Step 2. Choose a split you can stick with, 80-20, 70-30, or 60-40. Step 3. Automate contributions. Step 4. Rebalance once or twice a year. That is it. If you want to get fancy, add a small satellite in emerging markets or international small cap value. But do that only after the core is built. Because the core is what compounds. The satellites are just seasoning. And a reminder, because this is weekly compounding, the goal is not to be right next month. The goal is to be invested in a way you can hold for 10 years without losing your mind. International stocks being hot again is not the reason to buy. It is the reminder that global leadership rotates, and you want to own more than one chapter of the story.